I'm here with Whittaker, award-winning financial analyst and founder of Liberty Sky Advisors. And he's been generous enough to have this quick sit down and share with us a little bit of his thinking about the state of media industry.
Oh, thanks very much, Antonio. It's a pleasure to be here.
Oh, thank you. And without further ado, I'm so intrigued that I want to just dig into the questions, if that's okay.
Absolutely.
So I think the first one, which is a question everyone has in mind, it's how much can the media industry actually sustain its growth? And is actually a real growth or just money changing pockets?
No, I mean, it's a great question. And I think if you'd actually looked, let's say 10 years ago, there was obviously a lot that was going on in terms of the exchange of money, as you said, money coming out of newspapers, particularly the publishing space, and going very much into the online sector as well. There's an interesting definitional question here, I think, as to what constitutes media. My view would be companies like Google and Facebook are actually media companies because they rely on advertising, and essentially are targeting the same sort of audiences that traditional media companies would do as well. And if you look at sort of that definition, what you would say is that essentially the media industry is growing fantastically well, that it's taking more and more share of pocket. But I don't think it's just also as well the online companies. I think you see it across the wide range of media companies. So, for example, you look at the music companies are delivering double-digit revenue growth. You look, for example, even traditional publishing groups, the likes of Relics, sort of are delivering again sort of mid to high single-digit revenue growth sort of over time. You see it also as well what's happened, and we'll talk about, I guess, this in a moment, in terms of broadcasters again are coming back and delivering sort of strong revenue growth as well. So I think what you've got here is that essentially with the consumer is putting more of their money towards sort of media services, and that is fueling growth. At the same time as well, what you've also got, I suspect, and you're starting to see this come through the results, is a realization that advertising really is crucially from a strategic standpoint for many firms. And I think there is starting to be this change in conversation from advertising being seen as a cost to really being seen as an investment. And that, again, should mean that actually what should happen is that in terms of media sector, it should grow its revenues over time and actually take more and more share of the overall pocket. So I would say, it's sort of in summary, more of growth rather than necessarily a transfer.
Absolutely. And specifically on the broadcasters, free-to-air, as we did touch upon it, what do you think they are doing right?
Well, funnily enough, actually, it's a great question because what you would say in some ways, you'd argue what they have done right is that they have kept their linear services.
Got it.
Sort of essentially sort of well programmed and have continued to invest in there. I think there was a risk. If, for example, you look at what happened with the newspaper space 10 years ago, the reaction in the newspaper space to the decline of advertising revenues was to go through a very heavy cost-cutting cycle.
Yeah.
And the issue with that was it exacerbated the problems. It caused really sort of a self-fulfilling prophecy in terms of the decline of those revenues. I think with the broadcasters, what they realized was they need to invest. And that invest both benefited their AVOD services and sort of the growth in AVOD, particularly for the free-to-air broadcasters, will be a game changer, both because it actually, sort of those services are growing more quickly than linear TV, but also as well what you're finding is the potential opportunity there to tap into other budgets, particularly around digital. So that was one element, I would say, and the continued investment that's going through in content. A second, and touched about it, was so far the efforts when it goes on AVOD have been by and large quite successful. Yet all the services in Europe in particular have managed to gain sort of a quite significant penetration amongst populations. People use them. The advertising growth is very strong, and therefore it's helping to grow these companies' top line. It was to say sort of, I guess, a flip side of that, maybe what they could do better. I think from the free-to-air broadcasters side, I think their forays into subscription video on demand have been mixed, shall we say, particularly in Europe. And I think it would be fair to say that their strengths lie more on the free-to-air and the advertising side, rather than necessarily trying to get into a space where not only do they not have much experience, but there is a risk also as well that they dilute their messaging because most consumers associate them with free broadcast content as opposed to paying for it.
Great. And And within this investment, I mean, they all have been able to access a lot of capital, all seem to have very sound business plans and so on. But then Netflix comes out and make an announcement that pretty much puts the whole SVOD business into question, right?
Yeah, exactly.
So how do you think this might affect both their own management confidence on their strategy of SVOD, as well as tapping into funding into their platforms?
Well, I think it's interesting with the results so far that you've got from the streaming services. I mean, a lot of attention, rightly, has been focused on Netflix because it's the purest model. If you look, for example, the results of people like Disney Plus, for example, actually beat expectations. A lot of that was driven by growth in India. So in terms of Peacock, again, the view was that their numbers were above analyst expectations as well. It is true that the market consensus has switched from the idea that the streaming services are an inevitable path to growth to one that is more skeptical and questioning really sort of how much is the potential base that's really out there for these services. I think the key thing that would emphasize it is that I think each of the companies probably has slightly different challenges. If I look, for example, in terms of Disney and what's going on with Discovery and so forth and Peacock, what those companies are able to rely on is they have a big banker of IP library content.
Yes.
And that is very, very important because particularly if you look at sort of what people tend to watch in streaming services, actually a lot of it tends to be historical content. And if you have that, that is absolutely great. I think the challenge for Netflix is that, it's almost it's a pure play. It doesn't have that IP content library. It's been trying to develop its own services, but that takes time to actually sort of go on board. And I think what we'd say is I think for Netflix, it's going to be more and more difficult. I think for the other players, what they can also rely on as well, they're part of conglomerates. So they can rely on cash flows that's coming through from their other units to finance the content that they actually need for their streaming services and the marketing. And that's what they're doing. Netflix, on the other hand, really is. I mean, sort of the phrase of one-trick pony is perhaps too harsh, but it is trying to deliver new revenue streams. But essentially, its core business model and what it relies on is the SVOD model.
Yes.
And if that is weakening as it is, there's a question mark there, how much cash can generate and how much the market is willing to sort of give it leeway in the future.
And on the topic around original content, right, which I think we never see so many numbers and so big numbers being thrown around, everybody spending billions on it. But on the other hand, there's a complete lack of data to support performance on it. Obviously, one might claim they're the video counts and so on, but most of the content they develop is targeted to a specific audience. And then there's no data to support and generate back to KPIs to prove if they have a winning strategy or not. How do you see it can be, or is it sustainable, the amount of investment put in original content with this lack of metrics, or there's another solution for it?
I actually do think it is. I think, again, you look at sort of there will be question marks raised over the streaming services to how much they can continue to invest and how much how much they can afford, and particularly again of Netflix. And the comments from Netflix would suggest that actually, it is looking to reduce some of its spend. But what we'd argue is, and Netflix is an interesting example. One of the stated problems of Netflix has been beyond a few core shows that obviously attract large audiences, there is a deep question mark over the filler product. The sort of second and third tier product that people, they watch the key dramas and then what do they go and watch? And a lot of the commentary is it's the same old documentaries and done the same sort of format. They don't really have much in the way of their sort of own IP. I think for the sort of how much firms will continue to spend, I think it will continue to grow. And I think there are two key points here. Sort of one is the longevity of content. Again, comes back to this point before, that it is not just content that you're showing for now, but potentially this content has a life shelf of 15, 20, 25 years. It's like what was said, for example, in terms of the most watched program on Netflix was Friends. Again, we're talking about a show that was developed in the 1990s. You can monetize this content over and over and over again, sort of with the synchronization model and so forth. And so potentially there's the example there that what you can get is you can sort of produce now and spend now, but you can have a very long life revenue stream. I think the second point also as well is that if you look at what the broadcasters are doing, the streaming companies, etc., more probably the broadcasters in terms of their advertising, this whole question of what exactly is their addressable market when it comes to advertising money. And my view is always that, essentially don't look at broadcasters, and streamers as TV companies. Look at them as video content distributors. And, that's an important distinction, because what it means is, I think there's a significant question mark over the next couple of years whether they will start to take money in the video advertising space that may at the moment be going to the likes of YouTube and Facebook and so forth. And if they can do that with their content, then that's going to be potentially the return that you would get on those investments will be very, very significant.
Absolutely. And it provides a good segue to changing the gears a little bit into the advertising space, right?
Yeah.
So in order for advertisers to be encouraged and start to venture into the VOD, which is so new, it will require some courage, which some might say that it would have to generate waste of advertisers. Some might claim that they're actually experimental money.
Yeah.
So how do you see that transition going from the advertiser's point of view?
I think I think typically what you tend to find with most decision makers is the old analogy of nobody ever got fired for using McKinsey's. And so, there is definitely an element of playing safe within there. And I think, certainly from a broadcaster standpoint, I think, there will be a bit of a challenge to actually get advertisers to say, look, in terms of, for example, your digital budgets, maybe some should come to our platforms. What would say is that in terms of the online space at the moment is very much in a world of in a state of flux. The changes that's been brought through with Apple, what that has meant, that the elimination of cookies, the rise of multiple walled gardens, firms deciding that essentially their data is a core strategic asset. What that means is essentially a lot of questions are being asked about the ecosystem that weren't being asked before on there, and increasingly questions asked about what is the waste that's been been used. Now, my view, this is a figure that gave yesterday at the conference, was, and this is essentially based on the calculation of saying there is probably too much overspend in search, there is probably wastage coming through in programmatic, there's a question mark of how much is spent on certain online video platforms and so forth. But the total shareholder value lost, if we look out to future forecasts, you're looking at around $2.25 trillion. That is a huge amount for advertisers. Really that is not something that can be overlooked. And so I think those sorts of questions around the loss in shareholder value, the need to reach audiences, and also as well that the environment, and it comes back to this point before about the nobody ever got fired from McKinsey's, the environment now is ripe for questioning of previously accepted models. And I think what you had before, certainly with some of advertising models, was almost what we'd call FOFO, fear of finding out. That many advertisers and marketers...
We have a new one now,
FOFO. We're scared of actually asking too many questions, because what would happen if they actually found out that essentially this money had been wasted and they had to go back to their bosses and explain what was happening. I think the changes that are going through provides a window of opportunity for many advertisers and marketers to take a deep look at what they're doing. The way that I've always looked at advertising, and particularly brand advertising, I always call it intangible capex. And I talk about this concept where essentially, just as a firm invests in physical capex, just as a factory, to build products, let's say to build cars, and the idea is that you invest up front, you realize there's a cost, you realize also as well that there is risk in terms of what you're doing and so forth, and you can't necessarily predict the future. But you know that you need to do that in order to generate future sales. And you know that if you get it right, then the potential in terms of that return that you will get will be very, very significant. It's the same, particularly on the brand advertising side as well. Again, it's crucial for long-term development. Yes, it is an investment up front, but it has a very, very long-term value if you get it right. And I would say, it comes on to another point as well. A lot of people talk in the advertising industry about return on investment. And that is the key metric. But what I would argue is that almost what you have here is that you almost have two different metrics that should be used for each different type of advertising. So brand and performance definitely should work together. You need both, no doubt about that whatsoever. But while return on investment, from a financial analyst standpoint, is very much a short-term metric and not one that we would really use, it's more suited to performance marketing. the likes of essentially brand advertising, which is really sort of built over the long term, and talk about long-term value, actually that's sort of the way that people should look at that, more akin to net present value or a discounted cash flow model, because again, it's sort of got a very, very significant lifetime. Actually, return on investment for brand advertising, actually, I would argue it is not only sort of not beneficial, it's positively harmful because it provides skewed outcomes.
And going into the whole experimental mindset, then I think a big question everyone has is the multiverse, like the metaverse and so on. How does this actually will transform, or which are the key trends that we should expect as we go into this new universe?
It's going to be an interesting one. I think at the moment, truth be told, I would be somewhat skeptical of the long-term success. But I think that's where we stand at the moment. Things can obviously change. I mean, my view is that necessarily, I think that there's a question mark of have we been here before with the likes of avatars, and you look at what the gaming companies have done. Similar sort of concept from years and years ago. You could also argue as well that there's a question mark if the metaverse becomes too successful and people are spending all their time in a virtual world. Do governments step in and say this is too much of a problem for so many things? But we don't know how things will necessarily develop. I think if we was to look at it now, I think what we'd say is that, I think brands will go off, obviously explore what could happen. There would likely to be sort of various niches that will probably do well. I think there is a question mark here in terms of the sort of the lack of cheap money that was maybe there 6 months ago as interest rates rise. There's a question mark there, sort of how that impacts the metaverse. Because if you look at things such as NFTs, for example, what they have benefited from is essentially the supply of cheap money by central banks that has enabled people to say borrow at close to 0% and then look for assets that generate a return. I think with the metaverse, there's a question mark, certainly where in that asset generation side, whether that will impact things. And I think on the advertising side, what you will see is particularly luxury goods, particularly certain types of retailers, you can see it now, will dip their toes in. I think one thing I would say is you are likely to find a lot of people who are sort of, again, will make a lot of money from the development of the metaverse. It will be the people who sell the pickaxes for the people who are looking for the gold. There will be there is so much money that's been pumped in. I mean, the figures I looked at this is around 3 to 4 months ago, things may have changed, was that just in terms of Meta alone, their metaverse investment would be something like $75 billion over 5 years. That is a very, very significant amount when you take the related all the related expenditure. And indeed, go to Oxford Circus, what have you got? Oxford Circus Tube, all on by the platforms, all plastered with essentially adverts for Facebook in terms of virtual reality. So it is clear there'll be a big push from this. It'll clear that a lot of people will need to look into it. It'll clear that essentially there'll be a lot of people who will do very well by developing services around it. My question would be at this stage, okay, if we look on a 10-year view, do we think this thing will succeed?
Yes.
And I think the jury is still very much out.
Wow. Okay. And I'm going to actually use the term that I just learned, which is FOFO, and letting my FOFO out, which is the fear of finding out. Yeah. I'm an average media person, right? What don't I know? And I should know.
Oh, that's a great question. I would say, I'd say you already know a lot anyway. So yeah. But I would probably say it's maybe, I'd actually answer that in 2 ways. I think one is, again, this point about sort of people in the media industry. I think, the risk they can be in a bubble. And not necessarily sort of see what's happening in terms of general consumers and their trends and what they would like. And to be fair, it's exactly the same, I would say, for investors as well, yes, in terms of things. And that, sometimes what that can do is, I would argue that it's sort of, there's a potential there to overlook common sense in terms of things. And I think, most consumers, generally take a gradualist approach to things. Obviously not all things. You see what's happening, for example, with mobile phones over the past 10 years and a transformation there. But generally, in terms of their media habits, they tend to follow a sort of a general pattern. Conversely, I'd say sort of the second sort of potential issue can be actually knowing too much. So the former US Secretary of State Colin Powell had this rule that you should never make a decision with less than 40% of the information,
yes,
and never make a decision with more than 70%. And the point being is that you need enough information in order to come to a considered view. But the problem becomes when you actually know too much information and you're going so much down in the detail that what you lose is you lose the oversight. And so I'd say that would be another thing as well, sort of in terms of actually the bigger picture and what's going on in the wider world. A lot of things what happening sort of will influence media. And as I said, I include sort of likes of Google and Facebook in this. They're very much being driven by trends that are at a higher level. You've seen this with, talked about it before, the valuations for many of these stocks like Netflix. One of the key issues there has been the changes of interest rates. That's not necessarily a media topic, but it's something on the outside world that has real life implications for the particular space. If you look at what's happening on the political and the regulatory side, again, that is going to have very real consequences for what goes on. So what I would argue is that essentially, sometimes it's better to have more of the wider overview and maybe sometimes a bit less on the detail when it comes to decisions.
And not forgetting, because I think your first point is very strong, which is about the bubble, right? And I think I'm going to conclude our chat with that because I think there's a good claim for diversity there. And we're going to make sure that we have representation of every point of view in the table because helps us mitigate any blind sides.
Absolutely. And it's such a crucial factor, and it goes across all strands. In terms of whether that be sort of your minority groups who are underrepresented, in terms also as well socioeconomic groups that may be underrepresented as well. There's a wide variety. I think it is always critical with this to have different points of view. This is. I'll end by actually going back to actually Netflix on here. When you look at Netflix, when they do their analyst presentations. Most companies will say they'll give their prepared remarks and actually have a number of analysts question them on what they've said. That's the way that you get out a lot of detail. Netflix, they'll have one pre-picked person that will ask them questions. You could see in terms of the range of answers that you get, it is is markedly sort of inferior in terms of that. And so what we'd say it's the same sort of thing when firms, in terms of their workforces. The more diverse a workforce you have, the more different range of opinions that you have as well, the more that people feel sort of as though they can question things, it's going to be for the overall benefit of the firm. And firms need to encourage that.
I could not think of concluding the conversation with a better message than that. Thank you so much,
Thank you so much, Antonio. It's great. Thank you very much.
Thank you.